Good morning, Synod. I know this is the graveyard session dealing with finance, but we can have a little bit more enthusiasm. Good morning.
Good morning.
Thank you. A few of you may be aware that I'm not the proverbial new kid on the block, and let me explain why. I've been working as an accountant in public practice throughout my career, and my previous firm, Kidson's, were appointed as diocesan auditors in the early 1990s. I was soon involved in advising the diocese on a variety of matters from that time. That's nearly 35 years ago. Following my departure in 2009 from Baker Tilly, a successor firm to Kidson's, I was co-opted onto the Finance Committee in 2010 and served there for over 11 years. And in March 2024, I was co-opted for a second time, nothing like being keen, onto the committee, and then succeeded Steve West as the DBF Treasurer. Rest assured, though, that I'm not the product of some ivory tower. Previously, I've served on my own village's PCC for 10 years, 6 of which as Treasurer. So therefore, I'm acutely aware of the financial pressures that PCCs face. Indeed, one year we managed to pay our parish share with literally pence left in the bank, which leads me conveniently onto the two topics I want to touch on this morning: parish share and reserves. The DBF receives income, the use of which is determined by the donor. Thus, we have restricted funds. Any income received which is not restricted is for the credit of our unrestricted funds. And from these unrestricted funds, the stipends and associated costs for our clergy are paid. The donations made from our 440 plus parishes by way of parish share account for over 3/4, 76% to be exact, of our unrestricted income. These donations are crucial for the diocese and the result of much effort and hard work on the part of parishes, not to mention tremendous generosity from all donors. For all these donations and contributions, I say a sincere thank you. My own parish's contribution, leaving only pence in the bank years ago, brings me to my next point, and this is the matter of reserves. The financial resilience of PCCs is important in enabling the current incumbent priest to foster the Church's mission. How money is used to that end is an important area for PCCs to decide, as well as deciding on an appropriate level of reserves. Regardless of whether or not they are registered with the Charity Commission, all PCCs are charities, and as such are expected to have a reserves policy and to work towards retaining reserves at the appropriate level. This will help to build financial resilience, but some PCs can and do end up with holding cash in excess of what is required under their reserves policy. In that situation, just holding on to that excess cash for no particular purpose cannot be said to be a charitable activity, and thus does not further the PCC's mission or that of the diocese. The excess cash needs to be used and not just stored away. The Charity Commission published guidance on charity reserves in their publication CC19. There's also guidance on the National Parish Resource website. So how has the diocese dealt with its own reserves policy? Page 12 of the financial statements forwarded to you with the agenda and other papers show that the diocese have a reserves policy, but simply put, is not strong enough financially to comply with it. The DBF lacks unrestricted cash. Whilst we can take actions to deal with it by realizing or selling assets, we come back to the vital importance of the parish share in the DBF's finances and its ability to operate. I'll hand you over now to Philip Codling to look at some of the highline figures from the 2025 financial statements. But before I do so, I'd like to acknowledge and thank the DBF's finance team of Philip Codling, Philip Keeble and Tracy Tibble for their efforts in keeping the DBF's finances in order. Thanks are also due to other members of the Finance Committee, especially Dawn Gillett, the Diocesan Surveyor, for their efforts for the diocese. So, Philip, over to you.
Thank you, Jonathan. Good morning, Synod.
Good morning.
Thank you. Right, so I'm going to refer, next slide, please. There we are. I'm going to refer to the accounts, or financial statements, as I should say. And you'll be pleased to see that this year the number of pages has slimmed from 68 to 64. So I'm sure you've all read it with great interest. The first slide, this one, is the income, the SOFA. And there's a few things that I will highlight for you. The first thing is there is a operating deficit, sorry, my commercial background comes through all the time, of 797, which compares with a prior year deficit of 249. Now, we don't like deficits, but that's the fact of the matter. These are consolidated accounts, so include the company that owns the St Nicholas Centre, and you may or may not be aware that the tower there needed significant repairs, which cost the princely sum of approximately £300,000. There again, my commercial background. Taking this one-off expense out of the figures reduces the operating deficit to around 500k, which is £250,000 worse than the previous year. So these are all lowlights. On a like-for-like basis, the operating deficit has increased by 250k. Right, so the lower part of the slide refers to the non-trading aspects of the accounts, which probably need some explanation. So the first line is gains and losses on investments. Each year, the glebe land which the DBF holds is required to be revalued. This year, in 2025, we had the advantage of a piece of land gaining planning permission. So the gain on the glebe lands was 343k, which was excellent news. Unfortunately, that was offset by CCLA losses of 413. By losses, I do mean that they are capital losses. The CCLA actually did pay us over 573 in dividends, or distributions as they prefer to call them. And although it's a very poor result in 2025 and it wasn't brilliant in 2024, we are looking at it, and in the long term, and I mean very long term because that's why we invest, they have outperformed their benchmark of CPI plus 4%. But I would like to assure everybody that the Finance Committee is looking into the topic pretty urgently. The lower part of the accounts is about a revaluation of property, so that needs some explanation. What we do here is we carry all the houses that we hold for the clergy and for curates at a value, in a book value. When they are put up for sale, we revalue that up to market value. So that generated the gain that we're looking at of 336. Yes, 336. So the value of restricted houses for sale is 1.6 million. Now that is to fund, when they eventually sell, the clergy house improvements, which you all were presented with, I think, this time last year. Next slide, please. Now on here, on my notes, it says it's self-explanatory. I hope it is. Parish share, it didn't increase, and I'm going to say meaningfully. We are very grateful for every penny that we get, but the costs have gone up in 2025, and parish share has not gone up in the same rate of costs. Our income did go up thanks to grants from Bishop's Council. In 2025, those grants were all restricted, which you can see on the SOFA. We've got the three columns: unrestricted, restricted, and endowment, page 27. So really, it wasn't a brilliant year for operating income. If we go to the next slide, you can see that that reflects the costs are pretty much under control in that the increase in spending, ministry and mission was funds received as restricted funds from Archbishop's Council. So the rest of it stays very much the same. Raising funds, which you can see in note 8 in the accounts, needs further explanation. That's where your £300,000 of repairs to the church tower sits. So if you take that out, you can see even raising funds is pretty consistent. Any income was restricted and it was related to the projects that we undertook. Next slide, please. The balance sheet, page 58. And I will flip to my own page 58 on the basis it's easier for me to read. So there's some movements here that there again will probably need to be looked at. Investments rose, cash went down. That's where we took the proceeds from James's school sale in 2024, which in 2024 reported as short-term investments. They are now properly invested in quoted investments, hence you get the change on your investments, which is worth noting. The change in net current assets also is the result of moving property. So we have an improvement in net current assets because they went from fixed assets into assets for resale. So page 58 is worth a quick look. I will refer back to Jonathan's point where the unrestricted net current assets are minus 153. That's not generally acceptable. The cash was minus 876. That is our unrestricted cash, non-existent in effect. The accounts would have been a challenge if we didn't have a plan to correct that. We have assets for sale of 598, which is a house that we've been trying to sell for quite a while. And as you may or may not know, the property market hasn't been as buoyant as we would have liked. So there is a timing difference, which is why it's quite so bad. And there is another property up for sale, both of which are nearing completion. So that 876 will have been corrected. That explanation was acceptable for the auditors, and so we're quite comfortable with it, but it does demonstrate that the DBF has very little unrestricted cash. And as Jonathan has already intimated, we understand that's not a dissimilar situation to many of the parishes. So that concludes the accounts.